The stock market crash of 1929 stands as one of the most significant events in financial history, marking the onset of the Great Depression. Leading up to the crash, the 1920s experienced an economic boom characterized by rampant speculation and a surge in stock prices. Many investors, driven by the belief that the market would continue to rise indefinitely, engaged in risky practices like buying on margin, which allowed them to borrow money to invest. However, this unsustainable growth created a bubble that was destined to burst. Understanding the 1929 crash is crucial, as it not only reshaped the American economy, but also influenced global financial systems. The aftermath led to widespread unemployment, bank failures, and a reevaluation of financial regulations. By exploring the causes and consequences of this pivotal moment, we can gain valuable insights into the complexities of economic cycles and the importance of sound financial practices. Join us as we delve deeper into the events that led to this historic crash and its lasting impact on society. The 1920s, often referred to as the Roaring Twenties, was a decade marked by significant economic growth and cultural transformation in the United States. Following World War I, the nation experienced an economic boom fueled by industrial expansion, technological advancements, and increased consumer spending. This prosperity led to a surge in stock market speculation, as more individuals sought to invest in rapidly rising stock prices, often without a solid understanding of the underlying companies. The cultural atmosphere of the Roaring Twenties was vibrant and dynamic, characterized by jazz music, flapper fashion, and a general sense of liberation. People embraced new lifestyles, and consumerism became a hallmark of the era. Key figures such as J.P. Morgan and industries like automobiles and consumer goods played pivotal roles in shaping the market. The excitement surrounding these developments contributed to an environment ripe for speculation, where many believed that the stock market would continue to soar. However, this unchecked optimism would ultimately set the stage for the catastrophic crash of 1929. On October 24, 1929, a day that would come to be known as Black Thursday, the stock market experienced a dramatic and rapid decline in prices, sending shockwaves through the financial world. As investors began to panic, they rushed to sell their stocks, fearing further losses. The ticker tape, which reported stock prices, fell behind as the volume of trades surged, creating a chaotic atmosphere on the trading floor. Major financial institutions initially attempted to stabilize the market by buying large quantities of stocks to restore confidence. However, their efforts were insufficient to quell the growing panic among the public. As news of the market's decline spread, everyday investors, many of whom had invested their life savings, were left in shock and despair. The immediate aftermath of Black Thursday saw a significant loss of wealth and trust in the stock market. By the end of the day, nearly 13 million shares had changed hands, marking a turning point that foreshadowed the more severe crashes to come in the following days and weeks. The immediate consequences of the stock market crash of 1929 were devastating, rippling through the economy and affecting banks, businesses, and individual investors alike. Many banks, heavily invested in the stock market, faced insolvency as customers rushed to withdraw their savings. This led to a wave of bank failures, further eroding public confidence in the financial system. Businesses too felt the impact as consumer spending plummeted. With investors pulling back and credit tightening, many companies were forced to cut back on production or lay off workers. This resulted in a sharp rise in unemployment, which soared to nearly 25% by the early 1930s, creating widespread economic instability and hardship for millions of Americans. In response to the crisis, the government began to take action, although initial efforts were limited. President Herbert Hoover implemented measures aimed at restoring confidence, such as encouraging banks to merge and providing loans to struggling businesses. However, these responses were often seen as inadequate, setting the stage for more significant reforms in the years to come. The stock market crash of 1929 was a catalyst that triggered the Great Depression, a decade-long economic downturn that profoundly affected the United States and the world. The crash shattered consumer confidence, leading to a drastic reduction in spending and investment. As businesses struggled to survive, layoffs became rampant, resulting in soaring unemployment rates and widespread poverty. The long-term effects of the Great Depression were felt across American society as families faced financial ruin and many lost their homes. The economic turmoil also had global repercussions, leading to a decline in international trade and contributing to political instability in various countries. Key events and policies emerged during this tumultuous period. The Dust Bowl, a severe drought in the 1930s, exacerbated agricultural struggles, displacing thousands of farming families. In response, President Franklin D. Roosevelt introduced the New Deal, a series of programs aimed at economic recovery, job creation, and social welfare. These initiatives reshaped the role of government in the economy and laid the groundwork for future social safety nets, forever altering the American landscape. The stock market crash of 1929 offers crucial lessons that remain relevant in today's financial landscape. One of the most significant takeaways is the importance of regulation in financial markets. The unchecked speculation and lack of oversight that characterized the 1920s contributed to the crash, highlighting the need for robust regulatory frameworks to protect investors and maintain market stability. Additionally, the crash underscores the necessity for economic resilience and preparedness. The Great Depression revealed how quickly economic conditions can change, emphasizing the importance of having contingency plans and safety nets in place to support individuals and businesses during downturns. The crisis of 1929 significantly influenced the response to the 2008 financial crisis, as policymakers sought to avoid the mistakes of the past. Unlike the contractionary monetary policy and lack of government intervention that exacerbated the Great Depression, the 2008 crisis saw aggressive action from central banks and governments, including lowering interest rates to historic lows, implementing quantitative easing, and providing substantial financial support to prevent a collapse in liquidity and maintain confidence in the banking system. This proactive approach, informed by the lessons of 1929, helped prevent the 2008 crisis from escalating into a prolonged depression on the scale of the 1930s. As we reflect on these lessons, it's essential to consider the relevance of history in today's economy. Understanding past mistakes can help us make informed decisions and avoid repeating them. By studying the events of 1929, we can better appreciate the complexities of financial systems and the importance of responsible investing, ultimately fostering a more stable and equitable economic future for all. In summary, the stock market crash of 1929 was a pivotal moment in history that not only triggered the Great Depression, but also reshaped the financial landscape for generations to come. We explored the economic conditions leading up to the crash, the chaos of Black Thursday, and the long-term effects on American society and the global economy. Understanding this significant event highlights the importance of regulation in financial markets and the need for economic resilience. As we reflect on these lessons, it becomes clear that studying economic history is vital for making informed decisions in today's complex financial environment. By learning from the past, we can better navigate future challenges and foster a more stable economy. If you found this exploration insightful, we encourage you to subscribe to our channel for more engaging content on economic history and other historical events. Don't forget to like this video and share it with others who might benefit from understanding these crucial lessons. We look forward to seeing you again in our channel. Together, we can continue to learn and grow from our shared history.